Welcome to TheoTRADE. This is Don Kaufman. It's December 15th, 2023. Just over 30 minutes stands between us and the weekend. Doing the TheoTRADE weekend update here on a Friday afternoon. Irrational FOMC Exuberance. Gotta love that title there. Look, what you just saw in the marketplace this past week, just an unrelenting short squeeze. I mean, you got to understand that hedge fund managers, portfolio managers, we're going to discuss this in detail, panicking, looking for returns. Again, I'll describe that here momentarily. Let's get right into it here on this weekend update. First and foremost, well, what can only be described is what I'll term rate cut mania. Let's actually first and foremost take a look at the spiders. So we're going to cruise over to the spiders, and we're actually going to go to the daily chart in the spiders. As I was talking about irrational FOMC exuberance, well, you need only look at that chart and kind of understand that. And a lot of this, of course, is being fueled, if you will, by as I said, termed rate cut mania. That's the only thing I can term it, is that everybody is looking for rates now to be cut. However, on that particular front, there was Fed speak today, not yesterday, not on Wednesday. Obviously, the Fed spoke, Jerome Powell spoke on Wednesday, but today we have had two individuals from the Fed not only have Fed speak, but specifically indicate that rate cuts, one of them said, hey, look, not until the third quarter. The other one said, we didn't even really discuss rate cuts. And yet, if you take a quick glance here with me at the Fed Fund Futures, this is actually Fed Fund Futures, the probabilities associated with it. Take a look at this is the January meeting. There's only a 12% chance of a cut in the January meeting, but right now, probabilities for the March meeting, they're live. And what that effectively means is the probability of a rate cut now. Of course, we're trading 520, 525, 550. There's about a 30%, only a 30% chance that we're actually going to maintain that 525, 550. And yeah, you're looking now as high as 70% chance of a rate cut in the March meeting. It's just, listen, it's absolutely shocking to me at this point. And, what does the Fed effectively see? Is the Fed really discussing this, or are they just trying to get the market to actually believe it, to back down those rates? They could be just using some rhetoric, not actually intending to cut Fed Fund Futures, but using, again, their power to ultimately talk the bonds and specifically the notes here for let me actually cruise over to the TNX once again. TNX talk the notes. This is the 10-year back down. I think they've done a fairly effective job of doing that. Anyway, the Fed speak and so forth will continue, of course, next week, the week after, into the next quiet period, and then the January meeting. Nevertheless, it is interesting to see, because less about the Fed speak and much more about the trade that's actually persistent afterwards. Capital rotations, absolutely epic in this marketplace. I mean, that's the only thing you can actually call it, is when I say capital rotations are epic, people, first of all, I've talked to a couple of hedge fund managers. There is sheer panic on their behalf, because a lot got caught short. Anybody caught short got really, really beaten up, and then actually shifted into some of the other wild rotations. Allow me to explain. When I say capital rotations are epic, the kind of thing that I'm talking about in here, well, let's start with the financials. The financials, which is, no one wanted to touch just a few weeks ago, have exploded to the upside. In fact, when I say no one wanted to touch them, you have to, let's quantify what no one wanted to touch them. The financials just a few weeks ago were actually down, close to about 9%. That's right in that neighborhood here. They were down 9%. They're now actually up almost 9% on the year. Nevertheless, this is exactly what I'm referencing here. Now, I want you to think about this for a second. Okay, so this is only one of the capital rotations we're seeing. And the reason I say I want you to think about this, because the financials are ripping higher. What do financials love? They love higher interest rates. But wait, we just showed you the TNX. The TNX is nothing but lower interest rates, right? So as the TNX absolutely crumbles, look, money right now, when I say that the capital rotations are epic, money right now is going anywhere they possibly can, okay? Because portfolio managers are in sheer, as I said, panic mode. And why are they in panic mode? It's not about getting beaten up. It's about one thing. It's about the S&Ps. And if you take a look at the S&Ps and you look at the year-to-date return of the S&Ps, let's just quantify that for a second. Okay, it's just over 20%. You're close to 23% in the S&Ps. All right, almost everyone that manages an active portfolio is dramatically underperforming the S&Ps. And the reason that they're dramatically underperforming the S&Ps is, here's the bottom line with the S&Ps. If you did not own a Microsoft, okay, an Apple, if you did not own an Amazon, okay, a Google, a Meta, in the same, again, in the same weighting that was in the S&P, you got smoked. You just simply got smoked by the S&Ps. And this is where a lot of people look and they go, you know, wait a second, what am I paying you for? What am I paying you for, man? You're trying to manage my portfolio. You can't even beat the S&P 500. Okay, Citadel, which is obviously everybody knows who Citadel is, the biggest market making firm. They're also a massive hedge fund. Citadel only up 15% at the end of November. Huge article about that. So Citadel at the end of November is only up 15%. They're one of the best performers in the entire street, okay? And they're underperforming the S&Ps. So what you're seeing coming into year end over here, okay, are these wild rotations of any, okay, any alpha, which is just returns to be generated in the last couple of weeks. I mean, look, you look at stuff like energy sector. In the energy sector, no one's wanted to touch this thing all year. I mean, at one point it was down, you know, as much early in the year. It was down 10%. It was down, rallied a little bit, faded hard. Look at the capital rotation into here. It's absolutely epic. Okay. Another one, I love looking at this one. I was showing this on Wednesday night's video. Look at the XLU, right? Utilities. Oh yeah, like you really want to be able to buy utilities. Oh, so just load me up in utilities. Okay, I gotta have it. Utilities burst, exploded by what? They were down on Wednesday, 10% in the year. They ended up on the day, okay, up almost 5%. Sick moves. Huge reversal, though, inside of this. And I'm telling you, there are funds that are just getting absolutely ripped apart in here. There are individual stocks, okay, that just simply defy comprehension. Look at Boeing. All right. And again, a lot of you are very familiar with some of these stocks and you're like, oh, okay. But it's important to actually know the driving, all right, and the driver behind this this latest move. Yes, okay, there is unequivocally, there is a real move into stocks, but this last little push to the upside, massive short squeeze. And again, what we are effectively seeing right now is sheer panic amongst portfolio managers. One of the more interesting things, though, on this front is big tech. Okay, outside of Apple, big tech really has not been involved. If you look at stuff like Nvidia, okay, this thing doesn't look anything like, you know, some of those other stocks. Okay, and it's, again, the proof's in the pudding over here. Amazon's been relatively flat. It's the upper edge of the range, I'll give you that, but it's been relatively flat. Microsoft, okay, has done nothing. These are not the driver behind it. What, again, you're ultimately seeing is these wild capital rotations try to eke out any returns. Probably my favorite on the screen has to be the Russell, okay, which again, if you look at this, apologize here, if you look at it on a year-to-date basis, the Russell, which was just a couple of weeks ago, as I was saying, and it literally is a couple of weeks ago, we're talking here the end of October, beginning of November, was down about 7%, is now up, okay, to the tune of almost 13%. But most of those returns, okay, most of the returns just came, right, in like the last, couple of trading sessions. All right, again, spectacular, again, epic, if you will, capital rotations. I can go on all day showing you individual stocks that just, it literally defies some logic out there. Okay, then you look at stuff like, you know, some of the Chinese stocks, they're still getting hammered, but hey, they're getting helped a little bit by the fact that China now is going to come in, okay, with stimulus. Looking at stuff like Walmart, there's no love in here. But again, I wanted to bring up just a handful of stocks on this particular front. Intel, okay? Intel's had no love for 5 years. No one's wanted to buy this stock for 5 years. Can't make that stuff up. Go look at a 5-year chart. What is the 5-year chart? Massively unchanged. No one's wanted to touch it for 5 years. But all of a sudden, it's one of the hottest things in the marketplace in the last couple of days. Okay? Find returns anywhere you possibly can. Shove capital in there, especially, okay, especially after the sheer panic that we saw to the upside, of course, on Wednesday. So the Fed sparks, as I said, irrational FOMC exuberance, turning into what I term rate cut mania. Look, I think this marketplace, and first of all, I was shocked, and I don't mind saying that. I'm shocked what Jerome Powell said. You know, the great Fed pivot. But I'm even more shocked when the other individuals from the Fed and the Fed speak today is coming out and literally saying they're like, no, okay, Bolsick just basically said earlier he's only looking at like 2 rate cuts, and it wouldn't even start again to the third quarter. Vastly, vastly different than what we're seeing inside of the Fed fund futures. All right, so again, financials ripping in lower interest rates. There's more question than anything. Portfolio and hedge funds panicking out there, try to make up returns. Okay, we are now seeing the dollar also rebound a little bit as well. This, and the reason I'm bringing up the dollar, I think this is going to be critical not only into year end, okay, but after the first of the year, okay, the possibility of the dollar actually rallying back as a degree of a hedge at this point. You know, one of the things though that's kind of striking about this is, even though we've seen this epic move to the upside right now, is it going to be sustainable? Is the short squeeze effectively over? And again, I think that's going to be considerable coming into this very next week of trade. And I know it's the holiday season. You know, you're figuring the volatility is going to die down. Could be anything but. Could be anything but. And I'm going to talk about that here in just a moment. Before I get there, I also want to talk about what has been a record high SKEW. For those of you that do not necessarily track SKEW, first of all, I'm going to open up SKEW for like a 10-year period, okay, just to get a good feel for it, like a 10-year period. And for those of you that are not familiar with SKEW, okay, first thing I'm going to say, where SKEW landed, this is actually yesterday's close, where SKEW landed is 162. It's the second highest print of SKEW ever, okay, since SKEW has actually been tracked. It's the second highest print of SKEW ever, and SKEW's only been around 12, 15 years, right? I'll even go to the max chart over here just to display that. So yeah, so it's been since 2011, as I said. You know, not forever, but second highest print ever was yesterday, all the way up at the 162. Now, what that implies, okay, and I'm not going to get into like every detail about SKEW. What it implies, okay, in the 30-day time frame, okay, because SKEW is actually measuring out of the money puts and their implied volatility versus out of the money call implied volatility, literally about some 30 days out. So what it basically implies is a significant demand for out of the money puts, and to finance those out of the money puts, they're clearly selling calls. So again, this would be somewhat of like a hedge and or a collar. Okay. Oh, what does that really mean? It means they're buying puts and selling calls. Supply and demand is actually tweaking the SKEW, if you will. Extraordinarily beneficial to us, me specifically, that is selling premium. I'm a premium seller. The higher the SKEW, the better it comes. Like our strategy of Ultima, okay, firing on all cylinders. Even though I'm actually running up against, the fact that I have to deal with a marketplace that's straight up, Ultima is absolutely unequivocally firing on all cylinders because the SKEW is sky high. So the SKEW, what does it really mean? You know what? Autonomously nothing. Like you can look and track SKEW back to its beginnings if you want, and a high SKEW unto itself, that 162 print of SKEW unto itself, it doesn't mean a lot. But it does when you start coupling it, okay, with an aspect like all of a sudden, don't worry about the day before over here. It looks like a mistick. But I will say that VVIX, that's the volatility index, came to life today. An 8% move in VVIX today. Yeah, you know what? That does mean something. There is heavy, heavy hedging going on specific to the VIX. Now, I've said this again and again. The VIX, if you're looking at the VIX on a day-to-day basis and trying to use the VIX, okay, to handicap anything, it's worthless. Unequivocally worthless. And still to this day, like, people have been looking at VIX since VIX actually came out. you know, and look, you got to change with the times over here, right? VIX is a dead instrument. Trading the VIX is absolutely, that's fine. It's on the table. But looking at the VIX as an instrument to measure volatility is not. That's just, look, no one trades 30-day options anymore. SKEW, okay, is indicative of hedging or trading way out of the money options that the VIX can't even measure. The VIX literally cannot even measure the options that are being traded for the SKEW calculation. Meanwhile, okay, even though the VIX is low, the options in the VIX, okay, designate VVIX. And when I say VVIX, it's the volatility index. And I'm going to tell you something right now. These things are trading, people. They are trading. Done almost 1 million contracts in VIX today. And now I'm paying attention because, again, SKEW on its own. I'm buying out of the money puts and selling calls. Doesn't mean a lot. But all of a sudden, when you start looking and coupling that with VIX options, and the VIX options, okay, they are huge, rocking out there. There is a very definitive move towards VIX calls, which is either one, hedging activity, because they're scared. You know, why would you buy VIX calls? If the market goes down, the VIX goes up. Okay, that could be one reason. You could be hedging. But the other one is you could be just completely speculating and saying, I'm going to buy VIX calls because sooner or later this marketplace is coming apart at the seams. You could do that as well. Either way you want to look at it. Okay, it's not a positive per se for the marketplace. Anyway, it doesn't unto itself, though, mean that, you know, we're going to crash and burn. It definitely, though, implies the professionals, though, they're out there. They're out there. They're definitely hedging, okay, you know, or taking shots to the upside for VIX. So just be aware of that here, okay? And, you know, even though we're coming into the end of the year, and you're going to look at in a moment, like in volatility in SPX, and the volatility kind of died down in the SPX, okay, it ain't over yet. Again, I'll discuss that in a moment. High impact moves in a low VIX continue. So back to the VIX. You keep seeing this VIX and you're like, it's at 12, man. It's not doing anything. Really? Because in a 12 VIX, I just want to tell you, in a 12 VIX, right now, where did the marketplace start this week? The marketplace started this week right around what? Oh, 46.05, where we presently trading. Oh, I'll tell you, about 105, 110 handles higher. That good enough for you? So over a 100-point move in the SPX, but you're like, oh, but it's a 12 volatility. And again, if you were like that old school that can't get out of like looking, you know, at anything but VIX, like, look, do you normally see 100-point moves in S&Ps and a 12 VIX? Of course you don't. Okay, because I'm going to tell you right now, it's not very accurate. The problem with the marketplace is, and call it a problem or call it a good, I don't really, you know what you want to call it. But one of the things, the VIX calculation can't see anything that is less than 9 days to expiration. And yet, all of the activity that exists in this marketplace is in short duration. Everybody focuses now on 0 DTE. I'm not saying you necessarily have to trade 0 DTE, but if we're all going to talk about 0 DTE, you should you should know, okay, that these volatilities, they can pick up in an instant. So this, you know, becomes like the VIX of the day, if you will. And I'll tell you what, like this next Monday, they're only looking like a 7 volatility, which is ridiculously low. Mark my words, that's going to skyrocket. They're going to rocket, okay, by like Monday. All right, so be aware. The VIX, not a great instrument anymore. Short duration volatility being measured, okay, by 3-day, 4-day, 5-day options out there, okay? And the reason I'm bringing that up is because, again, what we're seeing is what I would term high impact moves, big moves with a relatively low VIX, which brings me to my next point over here. Let's go actually look specifically at the SPX, as I call this, the mother of all products. And it is the mother of all products because a lot of the order flow that you see day to day is all driven, okay, by SPX. Trades are done in the SPX. The trades that are done in the SPX are laid off right here in the S&Ps. The SPX had a massive expiration today. It was the single largest expiration, okay, in SPX history, which basically means more options expired this morning. It's actually called the opening print. More options expired this morning than really ever before on a notional value front. Meanwhile, okay, we smashed expected move this week. An expected move was supposed to be plus or minus, just round this to a $65 move. Actual move, well, that's not set in stone. You got 13 minutes left to the closing bell. But I'll tell you one thing, we smashed through it. You're at basically a 100-point plus move, just over $100 move inside the SPX. In fact, at one point yesterday, we actually saw exactly a 2 sigma move to the S&Ps, and ironically, we stopped literally at a 2 sigma and reverted back down. So be mindful of that. And why I say be mindful of it, because next week. So next week, as I said, you're coming into the holiday season, and you can look at the December 18th expiration, like nothing's gonna happen. Okay, look all the way out to like next Friday. Next Friday is December 22nd, and you're only measuring right now at about $54 of volatility. Now, granted, we don't have an FOMC meeting, yada yada yada. But people, there's still a lot of data coming out. A lot of data coming out. I mean, some GDP prints. It just goes on and on. The jobless claims. Okay, I could spend all day looking at just all of the data points that are going to come out. And people, every single data point right now, every one of them, okay, has amounted to a market move. So hands and feet inside of the vehicle, even into the end of the year, because there could again be what I call it's high impact moves in a rather low VIX environment. All right, so the other aspect, okay, I would really consider this next week inside of trade is there is some more Fed speak. And one of the things we're going to be dealing with, okay, is people trying to kind of parse through. Are they really actually going to turn around and try to cut rates? Okay, and is that really even going to be on the table in March? I have to tell you, I, for one, am not a believer by the March expiration. I think they're going to push that thing way out. There's no chance they're cutting rates unless the Fed knows something we don't, okay? Meaning like the economy would have to be absolutely tanking, if you will, for them to turn around and cut rates. But again, it's a lot to think about because in the end, what are we really talking about? Talking about cutting rates, which sure, you can call it bullish for the marketplace. But when you're cutting rates, isn't the economy softening at that point? Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.